Back in 2016, the math on an average lifestyle made sense. You could snag a concert ticket for $50, lock in a 4% mortgage, and order takeout on an app that essentially paid you to use it. Today, those exact same habits are blowing a hole in your budget. Between the inflation spike of 2020 and venture capital drying up for tech startups, the subsidies that propped up that cheap lifestyle are gone. The actual cost of doing business is finally being passed directly to us. This table compares the baseline cost of normal from 10 years ago to today. Look at the jump from a $490 car payment to $750, or mortgages climbing to 7%. What used to be considered a standard, accessible choice is now priced like a luxury expense. So we have to rethink how we spend. We're going to run a strict return on investment analysis on 10 everyday financial defaults. We are looking solely at the input cost versus the actual value you get out of it today. Escaping this new convenience tax is the only mathematical way out. If you want to stop feeling perpetually broke and actually build long-term compound wealth, you have to cut the habits that no longer make financial sense. Let's start with food delivery apps. 10 years ago, they were a cheap novelty to get us hooked. Now, outsourcing your food pickup is a daily drain on your cash flow. Look at the stacked bar chart comparing the exact same order. In person, this burrito is $15, but the moment it hits the app, you get hit with a hidden 30 to 40% menu markup. Then you add service fees, bag fees, and a tip, and you're paying $22 for the exact same meal. And if you think a subscription model solves this, run the numbers again. You're literally paying a monthly fee just to get the privilege of having your delivery priced at a mildly less terrible rate. Even picking up traditional fast food yourself isn't the value it used to be. A combo meal is easily $14 now. For that price, you could sit down at a local, casual restaurant and get real food instead of something shipped frozen from a factory. You are trading maybe 20 minutes of driving for a massive recurring tax on your income. Uninstalling these apps and picking up your own food is the easiest cash flow fix you can make. Upgrading your vehicle is where the math gets genuinely dangerous. Brand new cars average around $50,000 today. Pair that with a 7% interest rate, and the average American is carrying a $750 monthly car payment. This graph shows why a 72-month loan is a trap. You pay $11,000 in pure interest for a rapidly depreciating asset. If you invested that $750 monthly into the S&P 500 instead, you'd gain over $1.1 million. The same logic applies to upgrading your phone every year. Tech companies have engineered product cycles to convince you to drop $1,000 annually for what amounts to an updated camera lens and a different colored case. Financing new cars and chasing annual tech upgrades forces you to prioritize fleeting social status over securing $1 million in lifetime wealth. It's a trade-off that simply doesn't add up. Another area where we overpay for the illusion of value is investing. When you buy into an actively managed mutual fund, you are paying a team of professionals a premium fee, usually around 1% of your total investment every year, to try and beat the market. But the data is clear. Over a 20-year timeline, between 85 and 90% of these highly paid active fund managers completely fail to beat a basic, passively managed S&P 500 index fund. Look at this comparison matrix. If you have $500,000 invested over 30 years, the difference between a low-cost 0.03% index fund and a 1% actively managed fund is a staggering $1.2 million. You lose over $1 million, not to poor performance, but simply to fees. Retail extended warranties run the same playbook. They catch you at the register when you're anxious about breaking an expensive laptop. It's a high-margin trap for the store, especially since premium credit cards already extend manufacturer warranties for free. Then there's the $7 trillion wellness industry. They sell you $300 athletic sets and $25 smoothies, promising health through expensive shortcuts. The reality is that daily walks, 8 hours of sleep, and real food do the heavy lifting, and those cost nothing. Paying financial premiums for expert wealth managers, retail warranties, and biological shortcuts mathematically guarantees worse outcomes than just doing the boring basics yourself. We also need to talk about the American dream of the starter home. High interest rates have completely inverted the math on real estate. In almost every major metro area, the cost of renting is now significantly cheaper than owning. If you put 20% down on a $1.2 million home at a 7% rate, factoring in property taxes and maintenance, you're paying roughly $8,500 a month. You could rent an equivalent property in that exact same neighborhood for $5,000. That is a massive gap in daily liquidity. Homeownership provides real psychological safety, and there's value in knowing you won't have to move. But strictly by the numbers, a starter home right now is a luxury expense, not an optimal financial maneuver. Cultural milestones are suffering the same inflation. Post-pandemic demand and ticket monopolies have permanently driven the cost of mega concerts into the stratosphere. What used to be a casual $50 night out is easily a $400 commitment once you factor in the service fees and travel. Stretching your budget for a starter home or funding hyperinflated stadium tours traps your vital cash flow. It leaves you with almost nothing to spend on high-value, localized experiences that actually improve your daily life. The overarching financial trap of 2026 is simple. The cost of outsourcing, whether you're paying someone to cook for you, invest for you, or entertain you, has been aggressively and permanently hiked. This scorecard maps out the alternatives. To generate real wealth, you have to embrace a little bit of friction. Buy a reliable 3-year-old used car in cash. Move your retirement to a 0.03% index fund. And rent a place while aggressively investing the difference. When it comes to status spending, adopt the invisible purchase rule. Before you swipe your card, ask yourself, would I still want to buy this if absolutely no one else could see it? If the answer is no, put it back. Stop funding hidden fees and middlemen. Take that saved capital and redirect it. Buy higher quality groceries and cook at home. Spend $20 to see a local artist in a small venue instead of $400 for nosebleed seats. Your baseline wealth is not dictated by macroeconomic inflation. It comes down to the math of your daily habits. By choosing a little short-term friction today, you secure your absolute financial freedom tomorrow.